Herzlich willkommen zum Schicksalstag für die Börse. Ganz dramatisch ausgedrückt, aber ihr wisst, es ist wirklich ein wichtiger Tag heute, denn in 3 Minuten werden wir live rüber in die USA schalten und schauen, was die Federal Reserve bei ihrer Sitzung in den letzten Tagen sich zusammengebastelt hat. Und wir haben ja schon lang und breit in verschiedenen Streams und verschiedenen Videos erklärt, warum der heutige Tag so wichtig ist und auf was wir heute achten müssen. Ich will noch mal ganz kurz die 2 wichtigsten Themen kurz zusammenfassen, die 2 Stichwörter euch geben. Wenn ihr diese beiden Stichwörter hört, dann müsst ihr eure Ohren spitzen und genau hinhören, Wort für Wort, was zu diesen Themen gesagt wird. Das erste ist Inflation. Bisher ging die Fed davon aus, dass die Inflation jetzt leicht steigt und ihre absolute Spitze, ihren Höhepunkt bei 2% im Jahr 2023 erreicht. Wenn die Fed heute sagt, 2% ist zu wenig, die Inflation wird höher laufen, 2,5%, 3%. Oder wenn die Fed sagt, die 2% werden nicht im Jahr 2023, sondern schon früher erreicht. Das wäre beides ein schlechtes Signal. Worst Case natürlich, sie sagen mehr als 2% und früher als 2023. Das wäre dann doppelt schlecht für uns. Zweites großes Thema, Bond Yields. Und wir haben es ja auch oben, ganz oben eingeblendet, die Renditen für 10-jährige Staatsanleihen, auf Englisch eben Bond Yields genannt. Und hier müssen wir auf 2 Dinge achten. Zum einen wird über zusätzliche Ankaufsprogramme gesprochen, eventuell. Das heißt, die Fed geht dazu über, Bonds vom Markt wegzukaufen. Oder sagt die Fed, dass das Kaufprogramm sich ausschließlich auf längerfristige Staatsanleihen fokussiert und nicht wie aktuell auch kurzfristige. Das wären beides gute Punkte, wenn das kommen würde. Das würde den Markt in einer Art und Weise beflügeln, glaube ich, wie wir es seit vielen Wochen, Monaten nicht gesehen haben. Wenn das Thema aber gar nicht angesprochen wird, dann müssen wir diese Kurve da oben oder die beiden, den Nasdaq und die Staatsanleihen, sehr gut im Auge behalten. Also es ist jetzt wenige Sekunden vor, ich glaube, es ist sogar schon, genau. Ich schalte einfach mal auf CNBC und wir schauen mal, was passiert.
2023. I think it's about a 9-vote decision right now, so it's absolutely on a knife edge. But I think it's possible that they will say, look, given our outlook, it just doesn't make sense to say that we'll keep rates flat into 2024, and that's obviously what we'll all be watching today.
Let's take a look at the markets right now, because we're right now going to go to Steve Leisman for the Fed decision. Steve.
The Federal Reserve leaving interest rates unchanged after its March meeting, but making some substantial and some not substantial changes to its forecast. First, the ones that didn't change. The median funds rate for the forecast sees no hikes through 2023. That's the median. There were some changes inside. I'll get to those in a second. It sees inflation at or above 2% this year through 2023, including 2.4% this year for the PCE indicator. It lowered the employment rate forecast to 4.5% for this year, going to 3.5% by 2023, and it boosted its GDP forecast. This is the average median forecast for all Fed officials, boosting it to 6.5% from 4.2% for this year. Talking about those famous dots, where are the Fed officials when it comes to the outlook for rates? 4 officials now see 2022 rate hikes. That's up from 1 in the prior, that is the December projection. 7 officials see 2023 rate hikes. That's up from 5, but still there's no change in the median because only a small number continue to call for those rates. Let's get to the statement now. The Fed saying, or a new change in the statement, that economic and employment indicators have turned up recently, though sectors affected by the pandemic have remained weak. Fed continues to see inflation running below 2%, that is its 2% target, and using some boilerplate language from prior statements, it's committed to using its full range of tools. The path of the economy depends on the course of the virus, and policy will remain accommodative until the Federal Reserve achieves its goals. Asset purchases will continue, as it said in the past, until substantial further progress has been made. The decision was unanimous. Tyler.
All right, let's follow up with a couple of questions. On inflation, they see for the full year, even though it's running below 2% now for the full year of this year, 2.4% inflation, 4.5% unemployment this year, dipping to 3.5% by 2023. Right. How close are they really, and what is the implication for policy? How close are they really to that dual mandate imperative that they want to hit, which is inflation of 2% or maybe a little above, and full unemployment, which is, I don't know what it is, 3.5%, 4%?
Well, I have to amend your question, if you will, Tyler, with all due respect.
Sure.
Remember, the goal is to aim for inflation above 2%. So
Correct.
It hits it this year. So maybe it hits that inflation goal, though it does go back down, pardon me, to 2% in the next 2022 and 23. And it gets to 3.5% unemployment. Now, I have to take a guess or a stab and say that's their goal, right? Getting back to the prior low unemployment rate. So that doesn't happen until 2023. So the dual mandate, if you take these literally and you make some assumptions about where their goals are numerically, they don't hit the dual mandate till 2023, and they don't see themselves really even raising rates then. The median forecast for the funds rate in 2023 remains 0.1%. Their longer run forecast, longer run goal or potential is 2.5% for the funds rate.
So let me ask you a quick follow-up here. You said that 4 of the members expect rate hikes, the first rate hike to be in 2022, next year, and 7 are predicting it for 2023. How big a difference is that from just the last meeting? I think you said there was only one who was going to go on the record as saying rate hikes were coming in 2023 or 2022. I've forgotten.
2022. I've got to look at 2 separate documents here, Tyler, if you don't mind, and I will tell you exactly what the story is. So there was one prediction for a rate hike in 2022. That's now 4.
That's
so
now 4.
3 became brought it forward, and there were 5 forecasts for 2023 rate hikes. These are back in December, obviously the last projections, and now there's 7. So obviously
how big a change is that? Put that into a context. Is that more than people expected, roughly what you might have expected, and how does it fit in historically?
I think it's in line. I think it's in line. Look, Tyler, during the pandemic and in the middle of the pandemic, we had nothing but doves on the FOMC panel. I think now, David Kelly was talking before about, is it 9-9? I think now what we're seeing here is a little bit of kind of, separation back to maybe some traditional stances that some of these FOMC members took, which is you're going to have some members who are going to be more hawkish. They're going to want to move a little faster. Some are going to be a little more dovish. I think when you have situations like that, well, you ask the most important question, where's the chairman? And I think the chairman right now is very dovish when it comes to wanting to keep interest rates down, keep policy in place until they achieve their dual mandate. It's significant. There's a discussion obviously going on. There are differences of opinion, but when the median doesn't change, it tells you that the full weight of the board remains behind this dovish policy.
All right, Steve, thanks very much. Courtney.
Thank you, Tyler. Steve, stick around with us. I want to get back to our panel for the reaction. Mona, there's a lot to work with here. Where do you want to go? You want to talk about the inflation expectations or the policy to remain accommodative? I guess that's not a super surprise. You tell me what was most surprising to you then in the statement from what Steve just read to us.
Yeah, it's interesting. It almost feels like a de facto easing. They really took up numbers for GDP growth this year, next year. 6.5% is actually above consensus for GDP growth of 5.6% or so. Unemployment rate down to 4.5% this year. That's also, below what the current consensus is. And so, raising those GDP expectations, taking down unemployment expectations, but leaving rates at the zero bound through 2023, essentially, is in some ways a continuation of this very easy, very accommodative tone. I think the good news for investors was just back in November, the Fed changed its average inflation targeting regime. And so now, even if their inflation forecast comes to fruition and we get inflation creeping up back above 2%, we know that the Fed's reaction function won't immediately be to think about raising rates. They may let it run hot, as we know, for some time, and that period of time is unspecified at this point. But I think the good news for investors is this is a very accommodative Fed still. And perhaps in some ways they just added some easing to this. The other quick point I'll make is, of course, investors are watching rates and what this does to rates. We are all looking at an environment where growth is accelerating, where inflation is potentially accelerating, where unemployment's coming down. Keep in mind, in the 10 years prior to the pandemic, the average 10-year rate was 2.2%, and the average growth rate was 2.3%, GDP growth rate. We're looking at an environment where GDP growth, at least for the next couple of years.
Okay, ihr seht also, der Markt hebt gerade ab. Die Botschaft der Fed wurde scheinbar vom Markt unfassbar gut aufgenommen. Die zwei wichtigsten Sachen. Die Fed hat nochmal bestätigt, dass die Leitzinsen auf keinen Fall vor dem Jahr 2023 angehoben werden. Und die Fed hat bestätigt, dass die Inflationserwartung nicht erhöht wird. Das heißt, die Fed hat mehr oder weniger die gleiche Erwartung, wie sie vor wenigen Monaten hatte, aber hat jetzt nochmal bekräftigt, und das ist, glaube ich, der wichtigste Punkt gerade. Die Fed sagt, Leute, selbst wenn die Inflation höher läuft, als wir es heute schätzen, und die 2% ist ja die Zielmarke der Fed, aber die Fed sagt, ihr braucht keine Angst haben, denn selbst wenn die Inflation höher läuft als diese 2%, werden wir das trotzdem nicht zum Anlass nehmen, die Leitzinsen früher als geplant zu erhöhen. Das war ja eine der Hauptängste, dass Leute gesagt haben, die Fed rechnet mit 2%, das ist völlig illusorisch. Wir werden viel höher als 2% Inflation bekommen aufgrund dieser unfassbaren Geldmenge, die ins System fließt. Und die Fed sagt, okay, selbst wenn ihr recht behaltet am Ende, selbst wenn die Inflation höher geht als 2%, wir bleiben bei unserem Wort. Die Leitzinsen werden nicht wie geplant oder nicht früher erhöht als geplant. Das ist, glaube ich, der Hauptgrund, warum der Markt hier gerade so positiv reagiert. Ich bin gerade nebenbei dabei, meine Short-Position zu reduzieren, aber wir warten natürlich noch auf den Termin in 20 Minuten, denn da gibt es die Pressekonferenz. Und wir werden sehen, welche Details da noch herauskommen und insbesondere, ob vielleicht das Thema Bond Yields, also Staatsanleihen, in dieser Pressekonferenz nochmal expliziter angesprochen wird. Das könnte nochmal etwas mehr Bewegung in den Markt bringen. Aber aktuell der Nasdaq in den letzten 10, 15 Minuten hier 0,7% gut gemacht. Viele Aktien, die rot gestartet sind, sind jetzt grün, wie beispielsweise eine Microvision, eine DraftKings, Amazon, Facebook, Etsy, Roblox. Der S&P ist jetzt grün. Also wir sehen gerade eine wirkliche Erleichterung im Markt, ein Aufatmen. Und wir werden schauen, wie sich das in den nächsten Minuten fortsetzt und natürlich, was dann gleich bei der Pressekonferenz noch an spannenden Infos herauskommt. Aber jetzt erstmal wieder zurück zu CNBC.
I mean, the bond market can take it, or at least the economy can take it right now. We're going to have a boom either way. So I'd rather see interest rates go up now when the economy can take it very easily, rather than sometime in 2022 when maybe the economy is slowing down. Maybe you've got an inflation problem, you do need to normalize rates. It's much more difficult to do then. So I think they ought to take advantage of this huge momentum that's building in the economy right now to try to get at least some way towards a normalizing monetary policy, because it'll be more difficult later. But I think that's what they're trying to do.
Mona, David seems to be saying that the greater risk is waiting too long to move. Do you see it that way?
Well, look, I think his point that the Fed has to acknowledge that they're making progress towards their dual mandate. They're putting it in their forecasts. Unemployment is improving. Inflation is picking up. Also a very strong economic year. So, to David's point, at some point over the next 2 years, it would actually make a lot of sense for the Fed to start thinking about at least tapering some of its asset purchases. The accommodation level that they have right now is really crisis mode accommodation level. This was at the heart of the pandemic. They needed to bring rates to the lower bound. They needed to increase their balance sheet to offer that liquidity. Clearly, we're seeing signs now that we are leaving crisis mode, and we're starting to exit crisis mode, and that would call for a change in the accommodation level. Really, they should do it in a way where they communicate it well in advance, and hopefully the markets can digest it. We're clearly starting to digest higher treasury yields as well. And in some ways, if you think about it, the higher inflation and higher yields and even higher federal funds rates, it's a good sign that the economy is improving. In some ways, you want a little bit of inflation.
Yeah.
When you look at areas like Japan and Europe that have just been in stagflation, no growth, no inflation, negative rates. It's a healthy sign in some ways to see the U.S. picking up in economic growth, inflation, and perhaps rates.
I want to get David first and then John with a quick observation on how the equity markets have responded to this relatively dovish set of information that they've received. Both the NASDAQ is up and the Dow has jumped. David, is this what you would have expected?
Yes, I mean, if the Federal Reserve continues to, what the Federal Reserve is doing and has done for many years is fuel a huge bubble, or a boom certainly, maybe not quite a bubble, but a boom in financial markets. It's still doing it. I mean, these super low rates make it easy to finance investments in equities and in fixed income. So I'm not surprised that equities are going up, but again, I think they have.
Wir können uns ja mal ein paar Aktien gemeinsam anschauen, wie der Markt reagiert. Ich schaue mal kurz, ob ich das schnell umschalten kann. Genau, so. Also, zum Bleistift haben wir... Oh, der VIX. Der VIX ist gecrashed. Aber ich sehe lieber den VIX crashen als den Nasdaq crashen, ehrlich gesagt. Die Position, die Call-Position auf den VIX habe ich gerade aufgelöst. Wir schauen uns mal ein paar Aktien an, wie der Markt reagiert. Eine Clever Leaves jetzt mit 6,8% im Plus. Eine Nano Dimension kann auch saftig zulegen gerade. Eine X1 kann zulegen, jetzt 4,1% im Plus. Auch Roku legt gerade zu. Selbst eine E-Hang steht von den Toten wieder auf. Wir haben Tesla, die jetzt wieder Richtung $700 marschieren. Wir haben eine Microvision bei $17,10. Wir haben eine Amazon. Ihr seht überall das gleiche Muster, ja. Alle Aktien im Bereich Tech laufen gerade nach oben, aber auch der S&P 500 läuft hoch. Das heißt, wahrscheinlich sehen wir gerade eine sehr breite Rallye im Markt und nicht nur bezogen auf Technologieaktien. Shopify im Plus, Airbnb im Plus. Einige Aktien sind weiterhin rot, wie zum Beispiel AMD, aber jetzt schon bereit, in die grüne Zone einzutreten. Dann haben wir hier noch eine Apple zum Beispiel. Auch Apple bewegt sich ganz klar nach oben. Wir haben eine Rocket, wir haben einen Ajax-Spec. Die Specs scheinen sich aktuell noch nicht sehr stark zu bewegen. Die Specs hat das Ganze eher wenig beeindruckt bisher. Mal schauen, was CCIV macht. CCIV scheint hier die Ausnahme zu sein. CCIV allein in den letzten 15-20 Minuten 6% gut gemacht. Jetzt bei $30,50. Ja, das sieht doch gut aus. Das sieht doch fantastisch aus. Wir haben hier NIO. Auch NIO konnte in den letzten Minuten zulegen um 3%, allein in der letzten Viertelstunde. CRISPR geht steil, also durch die Bank weg steil, bis auf die Specs, würde ich sagen. Und was macht der Bitcoin? Das würde mich jetzt interessieren. Denn ihr wisst ja, dass extrem viele Anleger Bitcoin als Inflationshedge kaufen. Das heißt, Sie kaufen den Bitcoin als Schutz vor der gefürchteten Inflation. Wenn jetzt aber die Fed rauskommt und sagt, Leute, das mit der Inflation, das haben wir im Griff. Ja, 2%, vielleicht ein bisschen drüber, vielleicht 2,5-3% im Jahr 23. Aber das sollte im Großen und Ganzen kein Problem darstellen. Dann ist jetzt die Frage, wie reagieren darauf Bitcoin-Investoren? Also schauen wir mal, was der Bitcoin jetzt macht. Auch der Bitcoin legt zu, jetzt bei 56.600 US-Dollar. Allein in den letzten 15 Minuten sind wir hier um 2,84% gestiegen. Also, der erwartete Abverkauf aufgrund positiverer Inflationsdaten ist bisher jedenfalls für den Bitcoin noch nicht eingetreten. Auch der Nexo läuft gerade ganz gut. Hey, vielen Dank dafür. Lieber Tim, danke für den Schweizer Franken. Wow, ich habe auf YouTube noch nie einen Schweizer Franken bekommen. Das ist auf jeden Fall eine Währung, von der ich gerne mehr im Depot hätte. Und auch vielen Dank fürs Mitgliedwerden, lieber Hagi S. Wir haben jetzt 100 Mitglieder. Das freut mich ganz besonders. Wir schalten mal wieder zurück zu CNBC.
Because the short end, of course, is hooked into the Fed most closely. If you look at 10s, what's fascinating here is it was at 166. The high was 168. You can see it's contained. But don't get too excited about contained because it didn't give up any ground. But here's the one you should be watching, the 30-year bond. The longest maturity, which is at the highest intraday yields, going all the way back, should it close above 241, 242 since August of 2019. And if you look at it, it took out its earlier intraday high, a fresh new cycle intraday high, and that's pretty much between that and the dollar index and the yield curve. Doves continue and investors continue to fade that the Fed can keep it all controlled. Courtney and Tyler, back to you.
Rick, thank you very much. And we've got some breaking news now out of Washington. Let's go to Elon Moy for the details. Elon.
Well, Tyler, the Treasury Department does plan to extend the tax filing deadline by 1 month from April 15th to May 15th. This comes as the agency faced growing pressure from both Democrats and Republicans to give people a little more breathing room to file their taxes in the middle of a very complicated financial year, and also allow the agency some time to implement President Biden's American Rescue Plan, sending out those stimulus checks, giving out expanded child tax credits, treating unemployment insurance a little bit differently. So Americans will now have more time to file their taxes. The deadline now, May 15th. The Treasury Department separately also coming under fire from Ohio, which is now
Nicola, vielen Dank. Herzlich willkommen.
over some of the limitations around state taxation that come as part of the aid given to states in that rescue plan. There are a number of states that have sent a letter to the Treasury Department, 21 states, calling for them to reconsider some of the strings that come attached to that COVID relief. We'll see where that one goes as well. Guys?
So what is, explain to me one more time, Elon, what the state's beef is with the American Rescue Act.
An die neuen Mitglieder, wenn ihr Mitglied werdet, dann erscheint im YouTube Community Tab der private Link für die private Telegram-Gruppe. Dort einfach draufklicken und dann kommt ihr in die private Gruppe. Vielen Dank.
Coronavirus Relief Fund. They are saying that's overreach by the federal government and an unconstitutional intrusion into their powers. And so now they are filing suit or threatening to file suit against the Treasury Department in order to prevent that from happening. We'll see what the courts decide.
Yeah, well, that's really a court issue, not so much a legislative issue, it would appear. But that is, from me sitting here, not someone as knowledgeable as you are about the ways of D.C. All right.
9 Minuten noch bis zur Pressekonferenz. Wir werden sehen, ob Jerome Powell höchstpersönlich spricht. Ihr seht den Countdown eingeblendet. 8 Minuten 46 Sekunden. Es ist ein bisschen unklar, ob Jerome Powell selber spricht, denn es gab so eine kleine Verwirrung mit dem Kalender der Fed. Denn dort erschien gestern noch, dass Jerome Powell heute spricht. Seit wenigen Stunden steht, dass er morgen spricht. Und deswegen gehen wir aktuell davon aus, dass Jerome Powell entweder heute nicht spricht, sondern einer seiner Vertreter, oder dass Jerome Powell heute und morgen spricht. Also, Wir sind gespannt. Palantir steigt auch, das ist fantastisch. Was erachtest du für einen guten Preis, um bei Nexo einzusteigen? Ich plane gerade ein detaillierteres Video zum Thema Nexo, wo ich auch eine Analyse des Nexo-Preises einbeziehe und auch über meine Zukunftsprognose für den Nexo-Token spreche. Aber jetzt so zwischen den Zeilen würde ich dir sagen, dass ich Nexo unter 3 $3 weiterkaufe. Hey, vielen Dank. 2 Euro.
Bester Mann, 100 Punkte.
Ich wusste gar nicht, dass das vorgelesen wird. Fantastisch. Vielen Dank dafür. Mein nächster Kaffee ist bezahlt. Weiß ich sehr zu schätzen. Mit den Einnahmen dieser Dinge wie den Livestreams mache ich zum Beispiel Dinge, wie dass ich das CNBC-Abo kaufe. Das habe ich dann für ein Jahr direkt abgeschlossen. Hat, ich glaube, 200 Euro gekostet. Das sind halt Dinge, die ich nur machen kann, wenn entsprechend auch Mitglieder diese Community unterstützen. Insofern vielen Dank dafür, denn letztendlich profitieren alle davon. Was war das Fazit von der Sprache von Jerome? Eher bullish oder bearish? Habe gerade wenig Zeit, mir das anzuhören. Chris, nochmal ganz kurz zusammengefasst. Ich glaube, die wichtigsten Punkte sind folgendes. Zum einen hat Jerome noch gar nicht gesprochen. Das folgt in wenigen Minuten, höchstwahrscheinlich. Zum anderen hat die Fed gesagt, dass sie nochmal bekräftigt, dass die Leitzinsen jedenfalls in den kommenden Jahren nicht steigen werden. Nicht früher und nicht höher steigen werden als bisher geplant. Das ist, glaube ich, das Wichtigste. Und sie haben auch gesagt, dass die Inflationsschwelle oder das Ziel für die Inflationsrate von 2% weiter bestehen bleibt. Aber sie sagen auch gleichzeitig, selbst wenn die Inflation etwas höher läuft, das ist okay für uns. Wir werden dann nicht sofort einschreiten und nicht direkt die Leitzinsen erhöhen, nur wenn wir mal eine gewisse Zeit eine etwas höhere Inflation sehen im Markt. Ja, das wäre sogar erwünscht sozusagen von der Fed. Und ja, das hat der Markt wirklich positiv aufgenommen, diese Versicherung. Das hätte ich persönlich auch gar nicht so gedacht, dass der Markt derart positiv darauf reagiert, denn letztendlich ist es keine wahnsinnig bahnbrechende News. So oder so ähnlich hat es die Fed immer wieder gesagt. Nur ist es natürlich nochmal erleichternd für uns, das jetzt nochmal schwarz auf weiß zu haben. Ja, wir werden aber sehen, was die Pressekonferenz gleich noch zutage bringt. Denn manchmal sind es ja die kleinen Details, die den Unterschied machen. Und die Zwischentöne, das, was zwischen den Zeilen steht, ist manchmal das viel Wichtigere. Insofern wird sowohl die Pressekonferenz in 5 Minuten gleich recht wichtig sein, aber auch der Termin morgen ein bisschen früher, glaube ich, als heute. Ich glaube 2 Stunden früher. Das müsste dann also in Deutschland um 17 Uhr, glaube ich, stattfinden. Aber ich werde das nochmal dann explizit euch mitteilen oder eben einfach den Livestream dann auf YouTube so planen, dass ihr seht, dann geht's los. Aber 17 Uhr könnt ihr euch schon mal einstellen morgen. Alles klar, wir haben noch 4 Minuten Zeit. Bei Palantir kam eine riesen grüne Kerze nach oben und dann dachte ich mir auch vor 20 Minuten, what the fuck. Okay, wir schauen uns nochmal Palantir gerne an, was da gerade passiert ist. Palantir. Ja, fantastisch. War jetzt natürlich nicht atemberaubend, denn wir waren hier nur leicht über dem Tageshoch, das wir heute Morgen gesehen haben. 1,16% über dem Tageshoch. Aber immerhin, ja. Ich bin ja, was die Palantir-Aktie angeht, wahnsinnig bullish. Halte auch aktuell Optionen, die natürlich jetzt ein bisschen in Schwierigkeiten geraten sind durch den Kursverlauf in den letzten Wochen. Aber ich habe ja noch 2 Wochen Zeit und kann mir überlegen, wie meine Strategie mit dieser Option weiter verlaufen wird. Ansonsten, was macht zum Beispiel Tesla jetzt? Nochmal schauen. Ja, Tesla hat jetzt wieder eine leichte Korrekturphase hier. Die $700-Marke waren dann doch eine Nummer zu groß. Aber wir werden natürlich auch sehen, wie wir dann kurz vor Feierabend den Markt dann schließen. Ob es dann noch eine schöne Rallye gibt in den Feierabend oder ob der Markt dann nochmal Gewinne mitnimmt. Das wird nochmal spannend zu sehen sein in den letzten Minuten. Ansonsten sollte jetzt in 3 Minuten eigentlich der Zirkus da losgehen bei der Fed. Wir hören nochmal bei CNBC rein, was die zu sagen haben.
What the individual members are thinking.
What about a taper timeline? Is it still appropriate for the Fed to be making the purchases at the level at which they are and for the foreseeable future? When does Powell need to begin to forecast that a little bit more clearly for the markets?
Mein Analysetool ist in der Videobeschreibung verlinkt.
About when they're going to need to taper. It's when there's significant progress. Very vague. It's in the eyes of the beholder. There'll be a lot of interesting discussion within the committee. So I think that if you look at them and they have a 4.5% unemployment rate at the end of this year, I think that's not quite low enough. I think it's going to have to be closer to 4.25, what we expected, like 4.2. And inflation at least 2%. So I think that's it's probably beyond this year, in the first quarter or most second quarter of next year.
So one quick question before we have to leave you. Did I hear you correctly then that you think that the earliest they will begin tapering those asset purchases is next year? And when might they start to signal that?
No, the earliest is December, and we were at December. But their forecast suggests to me that it's more likely to be in early next year.
All right, Governor Meyer, thank you very much for being with us. Larry Meyer, always good to see you. Thank you so much. As we wait court for Jay Powell, we said at the top of the broadcast that this meeting feels a little tonally and textually different, and I think to a degree we have gotten that with the changes in when certain governors expect interest rate hikes over the next couple of years. It's not a dramatic change, but it is, I think, a subtle and notable one.
Yeah, and I think notable for the markets too. We saw pretty notable moves in all of the major indices. The NASDAQ is now slightly negative again, but it did go positive in reaction here. And I think that Chair Powell is going to have to walk a very careful line in this press conference because the numbers, when you're looking at the economic metrics, don't necessarily, outside of anything else, match up with what the Fed is currently continuing to do. It looks like things are massively improving, yet the Fed policy remains very, very accommodative.
And you've got, obviously, since the last meeting, you've got nearly $2 trillion worth of stimulus coming online, checks actually going into people's pockets and bank accounts this week. In a big way, something that I don't know whether he counted on that, but let's find out what he has to say because here is Chair Powell.
I would like to start by noting that it has been a full year since the pandemic arrived with force on our shores. Looking back, it was clear that addressing a fast-moving global pandemic would be plainly and primarily the realm of healthcare providers and experts. And we are grateful to them and to all the essential workers for their service and sacrifice. The danger to the U.S. economy was also clear. Congress provided by far the fastest and largest response to any post-war economic downturn, offering fiscal support for households, businesses, healthcare providers, and state and local governments. Here at the Federal Reserve, we rapidly deployed our full range of tools to provide relief and stability, to ensure that the recovery will be as strong as possible, and to limit lasting damage to the economy. We are strongly committed to achieving the monetary policy goals that Congress has given us, maximum employment and price stability. The economic fallout has been real and widespread, but with the benefit of perspective, we can say that some of the very worst economic outcomes have been avoided by swift and forceful action, from Congress, from across government, and in cities and towns across the country. More people held on to their jobs, more businesses kept their doors open, and more incomes were saved as a result of these swift and forceful policy actions. And while we welcome these positive developments, no one should be complacent. At the Fed, we will continue to provide the economy the support that it needs for as long as it takes. Today, the FOMC kept interest rates near zero and maintained our sizable asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. The path of the economy continues to depend significantly on the course of the virus and the measures undertaken to control its spread. Since January, the number of new cases, hospitalizations, and deaths has fallen, and ongoing vaccinations offer hope for a return to more normal conditions later this year. In the meantime, continued observance of social distancing measures and wearing masks will help us reach that goal as soon as possible. The economic recovery remains uneven and far from complete, and the path ahead remains uncertain. Following the moderation in the pace of the recovery that began toward the end of last year, indicators of economic activity and employment have turned up recently, although the sectors of the economy most adversely affected by the resurgence of the virus and by greater social distancing remain weak. Household spending on goods has risen notably so far this year. In contrast, household spending on services remains low, especially in services that typically require people to gather closely, including travel and hospitality. The housing sector has more than fully recovered from the downturn, while business investment and manufacturing production have also picked up. The overall recovery in economic activity since last spring is due importantly to unprecedented fiscal and monetary policy actions, which have provided essential support to households, businesses, and communities. The recovery has progressed more quickly than generally expected, and forecasts from FOMC participants for economic growth this year have been revised up notably since our December summary of economic projections. In commenting on the stronger outlook, participants noted progress on vaccinations as well as recent fiscal policy. As with overall economic activity, conditions in the labor market have turned up recently. Employment rose by 379,000 in February, as the leisure and hospitality sector recouped about 2/3 of the jobs that were lost in December and January. Nonetheless, employment in this sector is more than 3 million below its level at the onset of the pandemic. For the economy as a whole, employment is 9.5 million below its pre-pandemic level. The unemployment rate remains elevated at 6.2% in February. This figure understates the shortfall in employment, particularly as participation in the labor market remains notably below pre-pandemic levels. Looking ahead, FOMC participants project the unemployment rate to continue to decline. The median projection is 4.5% at the end of this year and moves down to 3.5% by the end of 2023. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been the hardest hit. In particular, the high level of joblessness has been especially severe for lower-wage workers in the service sector and for African Americans and Hispanics. The economic dislocation has upended many lives and created great uncertainty about the future. Overall inflation remains below our 2% longer-run objective. Over the next few months, 12-month measures of inflation will move up as the very low readings from March and April of last year fall out of the calculation. Beyond these base effects, we could also see upward pressure on prices if spending rebounds quickly as the economy continues to reopen, particularly if supply bottlenecks limit how quickly production can respond in the near term. However, these one-time increases in prices are likely to have only transient effects on inflation. The median inflation projection of FOMC participants is 2.4% this year and declines to 2% next year before moving back up by the end of 2023. The Fed's response to this crisis has been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As we say in our statement on longer-run goals and monetary policy strategy, we view maximum employment as a broad-based and inclusive goal. Our ability to achieve maximum employment in the years ahead depends importantly on having longer-term inflation expectations well anchored at 2%. As the committee reiterated in today's policy statement, with inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. I would note that a transitory rise in inflation above 2%, as seems likely to occur this year, increase our holdings of Treasury securities by at least $80 billion per month and of agency mortgage-backed securities by at least $40 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. The increase in our balance sheet since last March has materially eased financial conditions and is providing substantial support to the economy. The economy is a long way from our employment and inflation goals, and it is likely to take some time for substantial further progress to be achieved. Our forward guidance for the federal funds rate, along with our balance sheet guidance, will ensure that the stance of monetary policy remains highly accommodative as the recovery progresses. Our guidance is outcome-based and ties the path of the federal funds rate and the balance sheet to progress toward reaching our employment and inflation goals. Overall, our interest rate and balance sheet tools are providing powerful support to the economy and will continue to do so. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We are committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible. Thank you. I look forward to your questions.
Howard from Reuters.
Hi, Chair Powell, and thanks for that. So could you talk us through how the forecasts for 2021 map into the substantial further progress definition? 2.4% inflation, I understand that's considered transitory. That still seems like some progress there. 4.5% unemployment. Is it time to start talking about tapering yet?
Not yet. As you pointed out, we've said that we would continue asset purchases at this pace until we see substantial further progress. And that's actual progress, not forecast progress. And that's a difference from our past approach. And what we mean by that is pretty straightforward. It is we'll want to see that the labor markets have moved, labor market conditions have moved, have made substantial progress toward maximum employment, and inflation has made substantial progress toward the 2% goal. That's what we're going to want to see. Now, that obviously includes an element of judgment. And when we see, we'll be carefully looking ahead. We also understand that we will want to provide as much advance notice of any potential taper as possible. So when we see that we're on track, when we see actual data coming in that suggests that we're on track to perhaps achieve substantial further progress, then we'll say so. And we'll say so well in advance of any decision to actually taper.
If I could follow up on that, the shift in the dots, why wouldn't that suggest a weakening of the commitment here? An awful lot of people shifted into 2022, it seems.
I don't see that at all. We have a range of perspectives on the committee. I welcome that. And, we debate things, we discuss things, and we always come together around a solution. But, the strong bulk of the committee is not showing a rate increase during this forecast period. And, as data improve, as the outlook improves very significantly since the December meeting, you would expect forecasts to move up. It's probably not a surprise that some people would bring in their estimate of the appropriate time for liftoff. Nonetheless, the bulk of the committee, the largest part by far of the committee doesn't show a rate increase during this period. And again, part of that is wanting to see actual data rather than just a forecast at this point. We do expect that we'll begin to make faster progress on both spending, labor markets and inflation as the year goes on because of the progress with the vaccines, because of the fiscal support that we're getting. We expect that to happen, but we'll have to see it first.
Great, thank you. Victoria.
Hi, Chair Powell. I wanted to ask about the supplementary leverage ratio. There's been a lot of talk about what you all are going to do this month, which I'm happy to hear an update if you have one. But just sort of more broadly, do you think long term that the leverage ratio poses problems for implementing monetary policy at a time when the reserve supply is going to remain large? And if so, do you think that changes to the leverage ratio, including the SLR, are the way to deal with that problem?
Victoria, we'll have something to announce on that in coming days, and I'm not going to expound upon your questions. Why don't you ask another question if you'd like to, because that one I'm just going to say that we're something in coming days.
Sure. Okay. Well, then I'll ask about unemployment. There's the unemployment rate is you all have projections for the U6 rate, but you've also been, really emphasizing the fact that that's not the only thing that you all are looking at. You're also looking at labor force participation and things like that. So are you all looking at ways of maybe adding to how you're projecting the unemployment rate to the summary of economic projections?
Well, let me say, as we say in our statement on longer run goals and monetary policy strategy, we look to a range of indicators on labor market. We never only looked at the unemployment rate, which is the only indicator of labor market outcomes that's in the SEP. We look at a very broad range. You hear us talk all the time about participation, about employment to population, which is the combination of the two, about different measures of unemployment. So it's wages, it's the job flows, it's all of those things they go into an assessment, disparities of various groups. All that goes into an assessment of maximum employment. The trying to incorporate all of that into the summary of economic projections would not be practical. Obviously the thing that we do include is just the unemployment rate, and that's a very insufficient statistic. So it doesn't include a lot of other things that we do look at. And I wouldn't want to say that we're looking to include the other dozen things that we look at into the SEP, but from time to time we do look at adding different things. But I would just say the SEP it's a summary. It's one device. It's not going to include all of the things that we look at. I think the things that we look at. We talk about them all the time. So we're not actually looking actively at significantly broadening those indicators in the SEP right now.
Thank you. Chris Rugaber, Associated Press.
Thank you. Chair Powell, I wanted to ask about the forecast overall. You're forecasting a very low unemployment rate next year, and in 2023, you have inflation, or the Fed overall is in the SEP forecasting inflation at or above 2% by 2023. Yet no rate hike in any of this forecast horizon. So is this telling us that you see a higher inflation rate than what's projected, or do you not? As you've been talking about, is the unemployment rate insufficient, or what is this telling us about the Fed's reaction function? That it seems you're meeting the Fed's dual mandate by 2023. Yet again, no rate hike expected.
So I guess the first thing to say is that the SEP is not a committee forecast. It's not something we sit around and debate and discuss and approve and say this represents our reaction function as a committee. It's a compilation of projections from different people, and but since we don't debate it or discuss it, it would be hard for me to say exactly why each participant did what they were going to do. So all I would say about this is that we've laid out what I think is very clear guidance on liftoff. And it's really three things: labor market conditions that are consistent with our estimates of maximum employment. And as I mentioned, we consider a wide range of indicators in assessing labor market conditions, not just the unemployment rate. Inflation that has reached 2% and not just on a transitory basis, and inflation that's on track to run moderately above 2% for some time. The first two of those three are very much data-based. The third does have a little bit of an element of expectations in it. So we are very much determined to implement this guidance in a robust way. It is the guidance that we chose carefully to implement our new framework. And to meet these standards, we'll need to see data, as I mentioned. So what does this SEP really say? It says that we're committed to our framework and to the guidance we've provided to implement that framework. We will wait until the requirements set forth in that guidance are clearly met before considering a change in our policy rate. And the last thing I'll say is this. The state of the economy in 2 or 3 years is highly uncertain, and I wouldn't want to focus too much on the exact timing of a potential rate increase that far into the future. So that's how I would think about the SEP.
Thank you. Paul Kiernan.
Thank you, Chairman Powell. My question is twofold. One, how high are you comfortable letting inflation rise? There is some ambiguity in your new target, as you mentioned, expectations driven. And do you think that ambiguity might cause markets to price in a lower tolerance for inflation than the Fed actually has, thereby causing financial conditions to tighten prematurely? Is that a concern? Thanks.
So we've said we'd like to see inflation run moderately above 2% for some time. And we've resisted, basically, generally, the temptation to try to quantify that. Part of that just is talking about inflation is one thing. Actually having inflation run above 2% is the real thing. So we've, over the years, we've talked about 2% inflation as a goal, but we haven't achieved it. So I would say we'd like to, perform. That's what we'd really like to do, is to get inflation moderately above 2%. I don't want to be too specific about what that means because I think it's hard to do that. And we haven't done it yet. When we're actually above 2%, we can do that. Look, I would say this. The fundamental change in our framework is that we're not going to act preemptively based on forecasts for the most part. And we're going to wait to see actual data. And I think it will take people time to adjust to that and to adjust to that new practice. And the only way we can really build the credibility of that is by doing it. So that's how I would think about that.
Thank you. Matthew Boesler.
Hi, Chair Powell. This is Matthew Boesler with Bloomberg News. So there's a widespread presumption at this point that the U.S. will reach herd immunity sometime this year. And all along, you've said that the path of the economy is going to be determined by the course of the virus. I'm curious, based on the projections that you released today that show unemployment will still be above estimates of maximum employment through the end of next year and perhaps sometime into 2023, do you think policymakers need to be doing more here to sort of align the herd immunity and full employment timelines, if you will? Thank you.
So on herd immunity, I'm really going to leave that question to the experts. We don't control that. We're not responsible for defining it. And we'll leave that whole discussion to the experts. I mean, what we're focused on is the part that we control, which is the support that we provide to the economy. And there we provided very clear guidance. And in the case of asset purchases, it's at their current level until we make substantial further progress. There is an element of judgment in that, and we'll supply clear communication well in advance of actually tapering. And we just went through the criteria for raising interest rates. They're very specific, and we're very much committed to having them fulfilled robustly. I would agree with you that the path of the virus continues to be very important. We have these new strains with it, which can be quite virulent, and we're not actually done yet. And
Ich glaube, es ist gleich
clearly
vorbei
on
und
a
dann
good path
Fazit.
with cases coming down, as I mentioned, but we're not done. And I'd hate to see us take our eye off the ball before we actually finish the job. So that's how I would look at that.
If I could just briefly follow up, how do you see sort of the disconnect in terms of an economy that is expected to be widely reopened this year, but full employment taking longer to achieve? Is it the case that factors related to the virus will still be with us over the coming years? Is that how to interpret the forecast?
I think there's some of that. Sure, there'll be some of that. There'll still be some social distancing. People may be, for example, going into spaces that involve close contact with others. Some people will do that right away. Others will hold back, and so I think there'll be some of that. In addition, though, remember there are 10 million people in the range of 10 million people who need to get back to work, and it's going to take some time for that to happen. It can happen. Maybe more quickly than it has in the past because it involves the reopening of a sector of the economy as opposed to stimulating aggregate demand and waiting for that to produce job demand for workers. This could be a different sort of a process, and it could be quicker. We don't know that. But it's just a lot of people who need to get back to work, and it's not going to happen overnight. It's going to take some time, no matter how well the economy performs. Unemployment will take quite a time to go down, and so will participation. So that's all I can say. I think the faster the better. We'd love to see it come sooner rather than later. We'd welcome nothing more than that. But realistically, given the numbers, it's going to take some time.
Thank you. Steve Leisman.
Mr. Chairman, thank you. I wonder if you could, kind of a three-parter here, but all related. Would you comment on the current level of the 10-year yield and some other long rates out there, whether or not you think they would have a negative effect on the economy? And if not, is there a level that would give you concern? And finally, the third part, other central bankers have expressed concern about what's happened to yields in their countries, and even some taken action, but not you. Could you give us your general idea or orientation towards the idea of coming into the market and affecting a particular tenor of the bond market? Do you like that idea? Do you not like it? Is it at the top of your toolbox, or is it something that you think is at the bottom of the toolbox?
Sure. So we monitor a broad range of financial conditions, and we're always attentive to market developments, of course. We're still a long way from our goals, and it's important that financial conditions do remain accommodative to support the achievement of those goals. And if you look at various indexes of financial conditions, what you'll see is that they generally do show financial conditions overall to be highly accommodative, and that is appropriate. So that's how we look at it. I would add, as I've said, I would be concerned by disorderly conditions in markets or by a persistent tightening of financial conditions that threaten the achievement of our goals. We think the stance of monetary policy remains appropriate. Our guidance on the federal funds rate and on asset purchases is providing strong support for the economy, and we're committed to maintaining that patiently accommodative stance until the job is well and truly done.
Could you give us an idea of how you sort of feel about that tool of being able to come into a particular part of the market and either doing an operation twist or something like that? Is that something you feel to be the top of your toolbox, or something that you don't really prefer?
The tools we have are the tools we have. What I'm telling you is that the stance of monetary policy we have today, we believe is appropriate. We think that our asset purchases in their current form, which is to say, across the curve, 80 billion in treasuries, 40 billion in mortgage-backed securities on net. We think that that's the right place for our asset purchases. Now, we can change them, of course, in a number of different dimensions, should we deem that that's appropriate. But for now, we think that our policy stance on that is appropriate.
Thank you. Rachel Siegel.
Hi, Chair Powell. Thanks very much for taking my question. You've spoken about the pandemic's disproportionate toll on Black Americans, Hispanic Americans, Asian Americans, and other groups in the labor market. And I'm curious if you can speak to specific indicators that the Fed will be using to measure job gains for groups that have persistently higher rates of unemployment compared to white Americans. And relatedly, since you've described vaccines as key to the economic recovery, is the Fed concerned about lower vaccination rates in communities of color, and what barriers do you think exist there? Thanks very much.
So which measures? So we do monitor and communicate very regularly about different labor market, disparities in the labor market, let's say. So the African American unemployment rate is substantially elevated, and so is the Hispanic unemployment rate. So we look at those and we see those as, it's slack in the labor market. It's sad to see because those disparities had really come down to record lows since we started keeping the data that way. As recently as a year ago, February of last year, we had those disparities quite low. What happens in a downturn, though, is they move up at twice the speed of white unemployment. So we monitor those things. Our tools, of course, affect unemployment generally, but we're going to look at those as a form of slack in the labor market and hope that that there's progress there. And this particular downturn, of course, was just a direct hit on a part of the economy that employs many minorities and lower paid workers. The public-facing workers in the service industries, in many cases, don't have a lot of financial assets. They're not tremendously well paid. They might have other jobs and things like that. So this was a direct hit on that part of the economy, and it's the slowest part of the economy to recover. So, we'd like to see those people continue to get supported, as the broader economy recovers, which is very much doing now. In terms of disparate levels of vaccination, those are facts, unfortunate facts. They're really not something we have within our policy toolkit to address, but it is true, though, that the data we have suggests that there are significant disparities between different ethnic groups, and but that's not for us. That's for fiscal authorities and the government more generally to work on.
Thank you. Gina Smialek.
Hey, Chair Powell. Thanks for taking our questions. I was wondering if you could talk a little bit about how you see the fiscal policy support that has come down the line affecting the economy's potential in the longer term, just in the sense that you've talked a lot about the potential for labor market scarring and how that might weigh on our sort of future prospects. And I wonder whether you see that sort of working in reverse. If we pull people back into the labor market more quickly, does that improve our chances?
So I do think that fiscal policy overall will have really helped us to avoid much of the scarring that we were very, very concerned about at the beginning. And I think that's just the size and the speed with which Congress has delivered, with the CARES Act and since then, is going to wind up very much accelerating the return to full employment. It's going to make a huge difference in people's lives, and it has already. As I mentioned in my opening remarks, the recovery has been faster than we expected. Part of that just is very hard to predict, given we've never seen an event like this. But part of it is just the strength of the fiscal response, which I think will look good over the years. Longer term, to really, the first part of it is about avoiding scarring, and I think we've not avoided all of the scarring, but we've probably avoided the worst cases there. And I hope we keep at it, and we will keep at it with our policies, of course, to do whatever we can to make sure that continues. Longer term, though, what it takes to drive productive capacity per capita or per hour worked to raise living standards over time is investment in people's skills and aptitudes, investment in plant and equipment, investment in software. It takes a lot of investment to support a more productive economy and raise living standards, and that's. That hasn't been the principal focus with these measures, our measures certainly, and we don't have those tools, but what Congress has been doing has mainly been replacing lost income and beginning to, support people as the economy returns to normal. But there should be a focus on, a longer term focus, I think, would be healthy on the investment front.
Thank you. James Politi.
Thank you, Chair Powell. I wanted to ask a question about the Eurozone. While the outlook for the U.S. economy has much improved, progress in the Eurozone has been far less encouraging, and it's showing signs of serious weakness due to the slower vaccination rollout and renewed lockdowns and restrictions. How worried are you about transatlantic economic divergence and the possibility that that trouble in the Eurozone and weakness in the Eurozone could drag down the U.S. recovery as it did in a way in the aftermath of the financial crisis?
You're right. The pace of the recovery is, we're having diverging recoveries here, as we did after the last crisis. And in this case, as well as the other one, the U.S.'s recovery is leading the global recovery. And, you know, we conduct policy, of course, here. Our focus is on our objectives are domestic ones. It's maximum employment or price stability here in the United States. We monitor developments abroad, and we know that because we know that those can affect our outcomes. So I think U.S. demand, very strong U.S. demand, if as the economy improves, is going to support global activity as well over time. That'll be through imports, and when the U.S. economy is strong, that strength tends to support global activity as well. So that's one thing. I don't worry in the near term. I'd love to see Europe growing faster. I'd love to see the vaccine rollout going more smoothly. But I don't worry too much about us in the near term because we're on a very good track. Very strong fiscal support coming. Now vaccination going quickly, and cases coming down. I think we're in a good place. It's all ahead of us, but the data should get stronger fairly quickly here and remain strong for some time here.
Thank you. Hannah Lang.
Hi, thanks so much for taking our questions. I wanted to ask if the Fed is planning on extending the same restrictions on bank dividends and share repurchases that are currently in place into the second quarter, and if you're considering at all the scenario analysis and mid-cycle stress tests that were in place last year, this year, and kind of what would make you consider doing something like that again?
So we haven't made a decision on that. We're a couple weeks away from announcing that decision. I won't foreshadow it here today. I will say we're going to continue our data-driven approach. You know that we restricted buybacks and dividends, so the firms are preserving capital. Through 2020, the banks actually increased their level of capital and their level of reserves. And the December stress tests showed that banks are strong and well capitalized under our hypothetical recessions that we used in December, which were quite stringent. We're right in the middle of our 2021 stress test, and we'll release those results before the end of June. And that layers, very significant additional stress on top of the stress the banks have already absorbed over the past year, with the unemployment rate going to 11% and stock prices falling more than 50%. So. But all of that, the results of the stress test and the decision on distributions, all of that is to come fairly soon, as I mentioned.
Thank you. Edward Lawrence.
Thanks, Chair Powell, for taking these questions. You laid out the standards to lift off. And back in June of 2020, you said, you're not even thinking about raising rates. But I see 7 members seeing liftoff in 2023 and 4 next year. How much debate and how can you characterize that conversation has there been about moving off the lower bound earlier than signaled?
Well, it all depends. We've set out very clear criteria for liftoff, right? Where we've said we want to see labor market conditions that are consistent with our estimates of maximum employment. And that doesn't just mean unemployment, it means a much broader set of criteria. We want inflation at 2% and not on a transitory basis, and we want inflation on track to be
Kommt in die beste Telegram-Gruppe Projekt 100
Everybody on the committee agrees to that, right? So it comes down to what's your projection for the economy. If you want to, people will have a range of assessments for how good the economy is going to be, and we don't. I would say that we're in a relatively highly uncertain situation. If you look at the uncertainty People on the committee broadly say that uncertainty about the forecast is very high compared to the normal level. We haven't come out of a pandemic before. We haven't had this kind of fiscal support before, totaling it all up. So you're going to have different perspectives from committee participants about how fast growth will be, how fast the labor market will heal, how fast inflation will move up, and those things are going to dictate where people write down an estimate of liftoff. Of course, this isn't a decision to lift off now. We make that decision then, but it's an estimate based on assumptions about growth, and it's meant to be a tool to generally show the public how our objective function works, how we think about the future. It isn't meant to actually pin down a time when we might or might not lift off. We're not going to make that decision for some time. The chances are that the economy in that time and place will be very different from the one we think it'll be. So sometimes with the dots, I have to be sure to point out that they're not a committee forecast. You know this, but they're not a committee forecast. It's just compiling these projections, really, of individual people. We think it serves a useful purpose. It's not meant to actually be a promise or even a prediction of when the committee will act. That will be very much dependent on economic outcomes, which are highly uncertain.
Thank you. We'll go to Brian Chung.
Hi there, Chairman Powell. I wanted to elaborate a little bit on your commentary about the fiscal stimulus. So it sounds like you, I guess, see the case for even maybe more investment, at least from Congress, to support the more productive economy, as you answered to Gina's question. So we just had $1.9 trillion in spending. So where do you see the fiscal space right now? Do you still, I guess, maybe see the country in a place right now where it wouldn't be a concern if there were to be more spending at this time?
No, so Brian, it's not up to us to decide what Congress should spend money on or when. I was answering Gina's question, which really was, how do we assure lack of damage to scarring, for example, or lack of damage to the productive capacity of the economy? And I think what's happened so far has done a pretty good job of that. But really, I wanted to make the longer run point that if to work on the productivity over longer periods, that comes down to a number of things, but one of those things is investment in people, in their skills, education, aptitude, all of those things. I'm not in any way suggesting that that's something Congress should work on right now, or that that's not our job. I'm just saying that is what fiscal policy can do. That really monetary policy can't do is invest in the future productive capacity of the economy, raise potential growth. Those things are completely tools that Congress has. And again, I wasn't making a comment at all on the current fiscal setting.
Thank you. Next to Michael Derby.
Great. Thank you for taking my question. I just wanted to get an updated view on your sense of your view on financial stability risks and whether or not you see any pockets of excess out in financial markets that concern you, either specifically to that area of the market or as in terms of like the threat that it could propose to the overall economy.
Sure. So, as you know, financial stability for us is a framework. It's not one thing. It's not a particular market or a particular asset or anything like that. It's a framework that we have. We report on it semi-annually. The board gets a report on it quarterly, and we monitor every day. And it has 4 pillars, and those are 4 key vulnerabilities: asset valuations, debt owed by businesses and households, funding risk, and leverage among financial institutions. Those 4 things, and I'll just quickly touch on them. So if you look at asset valuations, you can say that by some measures, some asset valuations are elevated compared to history. I think that's clear. In terms of households and businesses, households entered the crisis in very good shape by historical standards. Leverage in the household sector had been just kind of gradually moving down and down and down since the financial crisis. Now there was some negative effects on that. People lost their jobs and that sort of thing, but they've also gotten a lot of support now. So the damage hasn't been as bad as we thought. Businesses, by the same token, had a high debt load coming in, and many saw their revenues decline. But they've done so much financing, and there's a lot of cash on their balance sheets. So nothing in those two sectors really jumps out as really troubling. Short-term, I mentioned funding risk as the last one. So we saw again in this crisis breakdowns in parts of the short-term funding markets. Came under a tremendous amount of stress, and they've been quiet since the spring. And we shut down our facilities and all that. But we don't feel like we can let the moment pass without just saying again that some aspects of the short-term funding markets and more broadly non-bank financial intermediation didn't hold up so well under great stress, under tremendous stress, and we need to go back and look at that. So a very high priority for us as regulators and supervisors is going to be to go back, and this will involve all the other regulatory agencies. It does involve all of them as well, and see if we can strengthen those things. So that's a sort of a broader, detailed look.
Thank you. Michael McKee.
Mr. Chairman, can you help me understand something about the SEP and your forecasts? The inflation that you're talking about for this year, say, is transitory. Then by 2023, you're back down to 2.1%. There's no forecast for a rate increase for 2023. If you get to 3.5% unemployment, but inflation's only at 2 or 2.1%, are you willing to leave rates at zero going forward from there, or roughly zero going forward from there? In other words, could we be in a Japan-like situation where rates just stay low because inflation does?
Well, again, I wouldn't read too much into the March 2021 SEP dot plot. Remember what it is. It's a compilation of individual by individual members. They're all making different assessments. They have different forecasts, economic forecasts. Some have more optimistic ones, some less optimistic. And also remember that the SEP doesn't actually include all the things that go into maximum employment, right? It only includes unemployment. So I would just say we've set out clear guidance. The message from the SEP that I would like to leave with people is we set out clear guidance. I mentioned what it was. It's inflation it's labor market conditions consistent with our estimates of maximum employment. And that's not just unemployment, it's all the other indicators. But overall totaling up to maximum employment. It's inflation at 2% and not on a transient basis, and inflation on track to exceed 2% for moderately for some time. Those are the criteria. We're committed to robustly implementing that guidance, and that's what this says. That's really all it says. We're going to wait until those requirements are met. And again, the state of the economy in 2 or 3 years is highly uncertain, and I wouldn't want to focus too much on the exact timing of a potential rate increase that far into the future.
If I could follow up, I'm just wondering, before 2019, shall we say, you were focused on the problems with having interest rates too low. Now, are you saying we're willing to live with it until we reach these goals, even if you reach your goal on maximum employment?
So what I would say is we're committed to giving the economy the support that it needs to return as quickly as possible to a state of maximum employment and price stability. And, to the extent having rates low and support for monetary policy broadly, to the extent that raises other questions, we think it's absolutely essential to maintain the strength and stability of the broader financial system, and to carefully monitor financial stability questions, if that's what you're getting at. We do that. We monitor them very carefully. I would point out that over the long expansion, longest in U.S. history, 10 years and 8 months, rates were very low they were at zero for 7 years, and then never got above 2.4% roughly. During that, we didn't see actually excess buildup of debt. We didn't see asset prices form into bubbles that would threaten the progress of the economy. We didn't see we didn't see a housing bubble. The things that have tended to really hurt an economy and have in recent history hurt the U.S. We didn't see them build up despite very low rates. Part of that just is that you're in a low rate environment. You're in a much lower rate environment, and the connection between low rates and the kind of financial instability issues is just not as tight as people think it is. That's not to say we ignore it. We don't ignore it. We watch it very carefully, and we think there is a connection. I would say there is, but it's not quite so clear. We actually monitor financial conditions very, very broadly and carefully, and we didn't do that before the global financial crisis 12 years ago. Now we do, and we've also, put a lot of time and effort into strengthening the large financial institutions that form the core of our financial system are much stronger, much more resilient. That's true of the banks. I think it's true of the CCPs. We want it to be true of other non-bank financial intermediation markets and institutions. So I think that's monetary policy should be, to me, provide for achieving our macroeconomic aims. Financial regulatory policy and supervision should be for strengthening the financial system so that it is strong and robust and can withstand the kinds of things that it couldn't, frankly. And we learned that in 2008, 9, 10. This time around, the regulated part of the financial system held up very well. We found some other areas that need strengthening, and that's what we're working on now.
Thank you. Anakin, CNN.
Thanks for taking my question. Jerome Powell, could you talk to us a little bit about the relationship between the persistent pandemic unemployment and the expected increase in inflation? Does the former offset the latter to some degree?
I'm sorry, could you repeat that? You broke up there for a second.
Oh, no. I was hoping that wouldn't happen. Can you hear me now?
Yes, yeah.
Okay, great. I was asking if you could talk to us a little bit about the relationship between the persistent pandemic unemployment and the expected increase in inflation. I'm wondering whether the former offsets the latter and to which degree you guys are monitoring this.
You're asking about the relationship between unemployment and inflation? Is that the question?
Yes, exactly.
Okay.
They offset each other, the persistent pandemic unemployment.
Yeah, I think I'm hearing you correctly. So I would say a couple things. There was a time when there was a tight connection between unemployment and inflation. That time is long gone. We had extremely low unemployment, not extremely low. We had low unemployment in 2018 and 19 and the beginning of 20 without having troubling inflation at all. We were at 3.5%. We were bouncing around with unemployment 3.5% to 4%. And it wasn't just unemployment. Participation was high. Wages were moving up. It was a very healthy thing. And we didn't see price inflation move up. There is a relationship between wage inflation and unemployment. But that has not, what happens is that when wages move up because unemployment is low, companies have been absorbing that increase into their margins rather than raising prices. And that seems to be a feature of late cycle behavior. So we're not when we seek to achieve low unemployment, high levels of employment, which is our mandate. We think we have the freedom to do that based on the data, without worrying too much about inflation.
Thank you. Going to Greg Robb.
Hi, thanks for taking my question. I wanted to follow up a little bit. I understand what you're saying about the dot plot and the message you're trying to send with the dot plot, but does the same apply for the taper tantrum? You've said that it's going to take some time to get some fundamental progress on your goals, but it seems like some time could now be any time.
Well, so we've said substantial further progress. Now, if you go back November, December, and January, progress in the labor market slowed very sharply. So you had an average of 29,000 jobs per month. If you go back and look at the level of job creation before that was very, very high, very high. So we weren't making any progress on the labor market from November through January. February, we saw a nice pickup, a good jobs report, 379,465 private sector. So that's good. It can go so much higher, though, and you know, it would be nice to see to really make faster progress. That's different from substantial progress. We'd like to see it be higher than that, and I think it will be. That's the expectation. Is you'll see now, I think, really strong job creation return. Not as high as it was in the very early days of the recovery, the reopening of the economy, but nonetheless very strong. Okay, so what I'm saying is, to achieve substantial progress from where we are, having had 3 months of very little progress, it's going to take some time. And we don't want to get into, I don't want to get into trying to put a pin on the calendar someplace, because it's going to be data dependent. When we see ourselves on track to make substantial further progress, we're going to say so. We understand fully that test is one that involves judgment. If you remember, during the global financial crisis recovery, we said quantitative easing number 3 was, the test was a substantial improvement in the outlook for the labor market. Well, what does that mean? Well, it means a substantial improvement in the outlook for the labor market. It meant we would communicate when we thought we had that. This is just like that, in a way. What we're saying is substantial further progress toward our goals. We'll tell people when we think, until we give us a signal, you can assume we're not there yet. And as we approach it, well in advance, we will give a signal that yes, we're on a path to possibly achieve that, to consider tapering. So that's how we're planning to handle it. It's not different really from QE3. And I think what we've learned from the experience of these last dozen years is to communicate very carefully, very clearly, well in advance, and then follow through with your communications. In this case, it's an outcome-based set of guidance, as our rate guidance is, and it's going to depend on the progress of the economy. That's why it's not appropriate to start pointing at dates yet.
Thank you.
Thank you. Don Lee, LA Times.
Hi, Chair Powell. As you know, households are sitting on a lot of excess savings, and I wonder if, combined with that, you have an unleashing of, pent-up demand. How much do you think that would affect inflation, and would you expect that to be transitory?
And everyone who's forecasting these, what we're all doing is we are looking at the amount of savings. We're looking at, we have reasonably good data on that, and we're looking at the government transfers that'll be made as part of the various laws, and we're trying to make an assessment on what will be the tendency of people to spend that money, the marginal propensity to consume. And from that, you can develop an estimate of the impact on spending, on growth, on hiring, and ultimately on inflation. So that's what we're all doing. And we have, we can look at history and we can make estimates, and those are all very transparent and public, and you can compare one to the other. And of course, we've all done that. And I think we've made very conservative assumptions and sensible mainstream assumptions at each step of that process. And what it comes down to is what I said before, which is there very likely will be a step up in inflation as March and April of last year drop out of the 12-month window because they were very low inflation numbers. That'll be a fairly significant pop in inflation. It'll wear off quickly, though, because just the way the numbers are calculated. Past that, as the economy reopens, people will start spending more, and that you can only go out to dinner once per night, but a lot of people can go out to dinner, and so and they're not doing that now. They're not going to restaurants, not going to theaters. That part of the economy, and travel and hotels, that part of the economy is really not functioning at full capacity. But as that happens, people can start to spend. It's also wouldn't be surprising if, and you're seeing this now, particularly in the goods economy, there'll be bottlenecks. They won't be able to service all of the demand, maybe for a period. So those things could lead to, and we've modeled that. Other people have too. And what we see is relatively modest increases in inflation. So, but those are not permanent things. What'll happen is the supply side, the supply side in the United States is very dynamic. People start businesses, they reopen restaurants. The airlines will be flying again. All of those things will happen, and so it'll turn out to be a one-time sort of bulge in prices, but it won't change inflation going forward because inflation expectations are strongly anchored around 2%. We know that inflation dynamics do evolve over time. There was a time when inflation went up, it would stay up, and that time is not now. That hasn't been the case for some decades, and we think we won't suddenly change to another regime. These things tend to change over time, and they tend to change when the central bank doesn't understand that having inflation expectations anchored at 2% is the key to it all. Having them anchored at 2% is what gives us the ability to push hard when the economy is really weak. If we saw inflation expectations moving materially above 2%, of course, we would conduct policy in a way that would make sure that didn't happen. We're committed to having inflation expectations anchored at 2%, not materially above or below 2%. So that's, I think if you look at the savings, look at all of that, model it, that's kind of what comes out of our assessment. There are different possibilities. I think it's a relatively unusual, very unusual situation to have all these savings and this amount of fiscal support and monetary policy support. Nonetheless, that is our most likely case. And as the data come in and the economy performs, we'll of course adjust. Our outcome-based guidance will immediately adapt, we think, to meet whatever the actual path of the economy is.
Thank you. We'll go to Scott Horsley for the last question.
Thanks, Chairman Powell. My question is about those supply chain bottlenecks, especially on the goods side. Are they getting better or are they getting worse? We saw they were sort of a drag on the industrial production numbers that came out yesterday. And what do you expect them to do to prices just in the short run?
I think it's impossible to say, frankly, with any confidence, but I would expect, it's very possible, let's put it that way, that you will see bottlenecks emerge and then clear over time, and you'll probably see that over a period of time because, really the strong data are ahead of us. Right now that the checks are going out just now, and that'll add to spending. COVID cases are coming down. Vaccination is moving now quickly. The really strong economic data is coming. It should be coming, assuming we stay on this track. And that's when you'll really know where the bottlenecks are. But you can see, though, that these are not permanent. It's not like the supply side will be unable to adapt to these things. The market will clear. It just may take some time. And some of the answer to that may be price. In many cases, it won't be price. You'll see that people are reluctant to raise prices. It's a little bit the story about, the wage Phillips curve does show that as unemployment goes down, wages move up. But companies choose not to try to pass that price increase along to their customers. So you'll see a lot of that here too, I think. Anyway, we'll see. But that's my basic sense. Thank you very much.
Thank you.
Fed Chair Jay Powell staying all in the Fed support for the economy. Welcome, everyone, to Closing Bell. I'm Sarah Eisen, along with Wilfred Frost. Stocks giving a thumbs up to Powell's remarks just now. The key takeaways, Wilfred, no change in policy when it comes to interest rates, stimulus, or even guidance. No hint that he's thinking about changing policy. Now is not the time yet to be talking about tapering or pulling back.
Okay, das Event ist vorbei. Mein Gott, ein bisschen zäh am Ende, aber es waren doch einige spannende Fragen noch dabei. Wobei ich einfach sagen muss, es gab hier keine großen Überraschungen heute. Ja? Ich glaube, was ich noch interessant fand in den letzten 60 Minuten, war, dass Jerome Powell nochmal ganz klar den Fokus auf die Unemployment Rate gelegt hat, also auf die Arbeitslosenquote. Aber gleichzeitig gesagt hat, das ist zwar unser Hauptziel, die Arbeitslosenquote auf ein Vor-Pandemie-Niveau wieder herunterzubringen. Aber, lieber Markt, verlasst euch nicht nur auf die Arbeitslosenquote, denn es ist eine Vielzahl von verschiedenen Kennzahlen, die wir da zusammennehmen, um zu beurteilen, ob der Arbeitsmarkt sich in einer guten Verfassung befindet oder in einer Verfassung, wo der Arbeitsmarkt weiterhin Unterstützung braucht. Das heißt, es wird nicht so einfach sein, dass wir jetzt uns jeden Tag die Arbeitslosenquote anschauen und wenn wir absehen können, aha, im nächsten Monat wird die Arbeitslosenquote wahrscheinlich auf dem Vor-Pandemie-Niveau liegen, wird es uns nicht möglich sein, daraus abzuleiten, ob die Fed beispielsweise ihre Maßnahmen früher als geplant lockert, sondern er hat gesagt, es ist ein komplexes Thema. Wir haben ganz, ganz viele verschiedene Faktoren, die wir da zusammenziehen, und er hat es zusammengefasst unter dem Wort Maximum Employment. Das ist das Ziel der Fed, Maximum Employment. Das heißt, den Arbeitsmarkt wieder auf ein Niveau zu bringen, so wie es vor der Pandemie der Fall war, aber wie gesagt, nicht nur allein basierend auf der Arbeitslosenzahl an sich. Das heißt, auch im Umkehrschluss, solange der Arbeitsmarkt noch so ein bisschen hinterher humpelt, wird die Fed nicht davon abrücken, ihre Maßnahmen weiter durchzudrücken, den Markt mit billigem Geld zu fluten und dementsprechend auch die positive Reaktion des Marktes in den letzten Stunden. Ich fand auch gut, dass er nochmal den Base-Effekt erklärt hat. Das habe ich ja auch in einem Video auf diesem Kanal schon getan, in dem Video, wo es um Inflationscrash geht. Und der Base-Effekt ist im Grunde genau das, was ich dort erklärt habe, nämlich, dass wir dazu neigen, dass der Markt dazu neigt, die Inflation in diesem Monat mit der Inflation im Vorjahr zu vergleichen. Also zum Beispiel März 2021 mit März 2020. Und das nennt er Base-Effekt, weil wir im März 2020 ja in einer negativen Inflation waren aufgrund der Pandemie. Heißt, wenn wir uns jetzt heute vergleichen mit der Inflation in diesem Monat im Vergleich zum Vorjahr, dann erscheint die Inflation wahnsinnig explodiert zu sein, aber es ist eine Illusion aufgrund des sogenannten Base-Effekts. Darauf hat er nochmal hingewiesen, das fand ich gut, denn mir ist es sehr wichtig, dass alle Marktteilnehmer verstehen in den nächsten Monaten, und wir haben ja einige CPI-Termine noch vor uns liegen, die ganz schön hässlich werden könnten, dass aber alle Marktteilnehmer verstehen, erstens Base-Effekt, macht mehr Sinn, die Inflation zum Vormonat zu vergleichen, jedenfalls aktuell, als zum Vorjahr. Und er hat auch nochmal darauf hingewiesen, dass, und das war diese berühmte Dot-Matrix, diese Punktmatrix, von der ich vor dem Stream erzählt habe, wo im Grunde jedes Komiteemitglied einen Punkt abgeben kann, wo diese Person schätzt oder an welchem Punkt in der Zukunft diese Person schätzt, wann die Leitzinsen angehoben werden. Und dann hat man immer so eine schöne Punktmatrix, wo man verschiedene Punkte zu verschiedenen Zeitpunkten in der Zukunft sieht. Und was wir jetzt gesehen haben mit dem heutigen Bericht der Fed, dass sich diese Punktmatrix leicht verschoben hat, konkret gesagt, dass mehr Mitglieder in dem Komitee jetzt davon ausgehen, dass die Leitzinsen früher steigen als geplant. Und das hatte ja auch einer der Reporter dort angesprochen, wie das dann zu deuten sei. Und er hat gesagt, Leute, diese Punktmatrix, das ist keine bindende Entscheidung der Fed. Das ist auch keine Prognose der Fed, sondern das sind letztendlich nur Meinungen einzelner Personen in diesem Komitee. Und er hat eben den Markt beruhigt und hat gesagt, auch wenn sich diese Punktmatrix leicht verschiebt, wir bleiben bei unserem Plan und ihr braucht keine Angst haben, dass sich jetzt die Meinung einzelner Personen in diesem Komitee sofort sozusagen in den Prognosen der Fed deutlich macht, sichtbar wird. Das waren die wichtigsten Punkte. Ansonsten war wirklich alles beim Alten, alles so, wie wir es im Bericht davor gehört hatten, in Bezug auf die Inflation, in Bezug aufs Wirtschaftswachstum, in Bezug auf die Arbeitslosenquote, keine großen Überraschungen. Dementsprechend der Markt jetzt positiv. Wir können gerade nochmal schauen auf die Charts. 10-jährige Staatsanleihen seit dem Start dieses Events gefallen auf minus 2,2%. Das ist eine sehr deutliche Absenkung hier. und der Nasdaq konnte dementsprechend profitieren mit derzeit plus 1,92%. Die diversen Einzelaktien sind natürlich noch stärker gelaufen. Eine Tesla zum Beispiel hat jetzt hier in den letzten Stunden 4,3% zugelegt. CCLV habe ich gerade im Chat gelesen, ist auch weiter stark dabei. CCLV jetzt hier auch 4,36%, genauso wie Tesla. Ja, also ich bin wirklich, ich würde sagen, positiv überrascht, dass es keine bahnbrechenden News auf der einen Seite gibt. Es gibt nur noch mal die Bestätigung, alles bleibt beim Alten, wir bleiben bei unserem Plan. Und dass der Markt hier aber so positiv darauf reagiert, das hätte ich ein bisschen weniger eingeschätzt. Aber es ist natürlich positiv, ja, ist gut für uns. Wir werden jetzt natürlich schauen, wir werden ein Auge darauf halten, was die Staatsanleihen in den nächsten Wochen machen ob sich jetzt endgültig diese Verbindung dieser beiden Sachen, Staatsanleihen, Technologieaktien, dass sich diese Verbindung jetzt hoffentlich final aufbricht. Ich glaube nicht, dass diese Verbindung bestehen bleibt, solange wir uns in der, ich sag mal, 1,6 bis 1,7er Marke weiterhin aufhalten sollten. Sollte es einen Spike geben, dann wäre es in der Tat möglich, dass diese Verbindung dann auch wieder in Kraft tritt. Deswegen bleibt es wirklich wichtig für uns, das im Auge zu behalten. Also wir können jetzt nicht sagen, oh, ja, das Meeting ist gut gelaufen, der Markt reagiert positiv, wir können das Thema jetzt vergessen. Das Thema bleibt aktuell. Das Thema bleibt im Raum, weil es ja auch von der Fed jetzt gar nicht vom Tisch geräumt wurde endgültig, sondern es bleibt eine schwelende Gefahr, die wir auf jeden Fall weiter beobachten müssen. Aber es ist jetzt keine konkrete Gefahr, die uns jetzt in absehbarer Zukunft bedroht. Wir hatten ja auch die Aussagen diverser Investmentbanken, Goldman Sachs zum Beispiel, haben gesagt, ja, der Markt hat eigentlich jetzt schon eingepreist, dass die Renditen auf 2% steigen werden. Ja? Wenn der Markt oder wenn die Renditen irgendwo zwischen 1,6 und 2% landen, dann sollte das für den Markt im Großen und Ganzen kein Problem darstellen und sollte einfach zu verkraften sein. Wir hoffen, dass diese Prognose auch eintritt. Und ich bedanke mich fürs Zuschauen, Leute. Wir haben morgen ja noch den Donnerstag und dann den Freitag vor uns. Und wir werden schauen, wie wir aus dieser Schicksalswoche herauskommen. Aktuell sieht es so aus, als könnten wir hier grün rauskommen, mit Gewinnen rauskommen. Wir werden das Ganze weiter beobachten. Kommt in die Telegram-Gruppe, wenn ihr noch nicht Mitglied seid. Dort diskutieren über 1000 Mitglieder, bald 1100 Mitglieder. Ist nochmal gut was dazugekommen in den letzten Wochen. Minuten aktuell diskutieren dort über 1000 Mitglieder, was gerade am Markt passiert. Also klickt auf den Link in der Videobeschreibung. Kommt auch in den Discord-Channel. Dort gibt es themenspezifische Chaträume, je nachdem, was euch thematisch am meisten interessiert. Ja, wir hören uns in der Gruppe. Ich wünsche euch eine gute Nacht nach Deutschland. Wir hören uns. Bis dahin. Ciao.